AI companies are setting money. Ablaze, OpenAI's Pre-Bailout Bailout plan. In 2025, one company lost $38.5 billion, not over 10 years, in a single year. And in that same year, it had promised to spend $1.4 trillion on equipment it hasn't built yet, for customers it doesn't have yet, to run a business that has never once turned a profit. That company is OpenAI, the maker of ChatGPT. And by every normal rule of business, a company like this should be terrified. Instead, its executives have spent the past year doing something much stranger. They floated the idea that the government might need to step in and guarantee their debt. Then they said they never asked for that. Then they offered the government a slice of ownership in the company instead. If that sounds like a company quietly building itself an escape hatch before anything goes wrong, you're not imagining it. And by the end of this video, you'll understand exactly how that escape hatch was built, one deal at a time. Let's start with the numbers, because the numbers are the whole reason this story exists. In 2025, OpenAI brought in $13.07 billion in revenue. That's a real number, and it's actually higher than what OpenAI had projected for itself. But in that same year, the company spent $34 billion in total costs and expenses and ended up $38.5 billion in the red. For 2026 alone, OpenAI's president, Greg Brockman, testified under oath in a courtroom that the company plans to spend $50 billion just on computing power. Not staff, not offices. Just the raw computing muscle needed to keep ChatGPT running and to train the next models. To put that in perspective, that's a bigger number than the entire annual budget of most mid-sized countries, spent by a single company on nothing but processing power. And here's where it gets more interesting. Back in February 2026, OpenAI told investors it expected to spend around $600 billion on compute through the year 2030. That was already a staggering figure. But by early August, that number had jumped again to roughly $750 billion, according to the Wall Street Journal. In the space of about 5 months, OpenAI added another $150 billion to its own spending plan. Meanwhile, the revenue it's projecting to eventually earn by 2030 sits at around $280 billion a year. So the company is planning to spend nearly 3 times its expected annual revenue every single year for the next several years just to keep the lights on. That gap between what's going out and what's coming in is the engine driving everything else in the story. And it's about to get a lot stranger because to cover that gap, OpenAI didn't just go to a bank, it built something far more unusual. Think about how a normal business deal works. A restaurant buys tomatoes from a farmer. The farmer takes that money and buys a truck to deliver more tomatoes. Simple, one direction, real money changing hands for a real product. Now, imagine instead that the farmer doesn't just sell tomatoes to the restaurant. The farmer also invests millions of dollars directly into the restaurant's bank account so the restaurant can afford to keep buying tomatoes from him. That's essentially what's happening across the AI industry right now, and it has a name: circular financing. Here's how it plays out with real companies. In September 2025, NVIDIA announced it would invest up to $100 billion into OpenAI. What does OpenAI do with money from the company that makes its chips? It uses a large chunk of it to buy more chips from NVIDIA. Then there's Oracle, which signed a cloud computing contract with OpenAI worth roughly $300 billion over 5 years, starting in 2027. There's AMD, where the arrangement could eventually give OpenAI a significant ownership stake in AMD itself, in exchange for OpenAI committing to buy AMD's chips. There's Amazon Web Services, with a commitment now totaling around $138 billion. There's CoreWeave, with contracts reported at $22.4 billion. Add up just the big publicly known cloud commitments alone, and you're already past $460 billion before you even count the hardware deals with NVIDIA, AMD, and Broadcom separately. None of these companies are lying about the deals. They're real, they're public, and they're legal. But watch the direction the money moves. NVIDIA gives OpenAI money. OpenAI uses that money to buy NVIDIA chips. Oracle builds data centers for OpenAI. OpenAI pays Oracle to use those data centers. Round and round it goes, and every time it completes a loop, it can look like new demand for AI is exploding, when really it might just be the same dollars traveling in a circle between a handful of companies. Bernstein research analyst Stacy Rasgon put it plainly when the NVIDIA OpenAI deal was first announced, warning that a deal of that size would clearly fuel concerns about whether this was propping up demand rather than reflecting it. But not everyone agrees this is a problem. And what one side sees as a warning sign, the other side sees as simply how big infrastructure gets built. Anthropic's CEO, Dario Amodei, has defended this kind of arrangement directly, explaining that when one company has capital and wants to sell chips, and another company is confident it will have the revenue eventually, but doesn't have $50 billion sitting around right now, pairing an investment with a long-term buying commitment isn't inherently improper. Investment firms like UBS have run the numbers too, and their conclusion, at least for now, is that the OpenAI NVIDIA arrangement represents something like 13% of NVIDIA's expected 2026 revenue. Big, but not so large that it swallows the whole company. Other analysts, writing for firms like Acadian Asset Management, have pointed out that in a genuine bubble, you'd expect to see companies selling stock to outside investors to cover these gaps. In most of these AI deals, that isn't happening yet. So here's the honest picture. This isn't proven fraud, and it isn't proven safety either. It's a structure nobody has tested at this scale before, and reasonable experts are reading the same numbers and reaching different conclusions. What almost everyone agrees on, though, is where the comparison keeps landing. People keep bringing up the late 1990s telecom boom, when equipment makers financed their own customers' expansion, right up until real usage failed to catch up with the promises, and the whole thing came down at once. Whether OpenAI is building toward that same kind of collapse or building something that just looks similar on paper is exactly the question nobody can answer yet. And that uncertainty is precisely why what happened next made so many people nervous. In November 2025, OpenAI's chief financial officer, Sarah Friar, was on stage at a Wall Street Journal event, and she said something that hadn't really been said out loud before. She suggested that the government could backstop the guarantee that allows the financing to happen, specifically for the debt AI companies take on to buy chips. When a reporter asked directly if she meant a federal backstop for chip investment, she replied, "Exactly. For a company that had just told the world it was committed to $1.4 trillion in infrastructure spending, this sounded like exactly what critics feared. A private company asking taxpayers to absorb the risk of a bet the company itself had chosen to make." The backlash was immediate. Within hours, Fryer walked the comment back, saying the word backstop had muddled her point, and that she simply meant government and private industry should play their separate parts. Sam Altman went further, posting publicly that OpenAI was not seeking a government backstop for our infrastructure commitments, and adding a line that would come back to matter a lot. "We believe that governments should not pick winners or losers, and that taxpayers should not bail out companies that make bad decisions." Even David Sachs, the White House's own AI advisor at the time, posted flatly, "There will be no federal bailout for AI," pointing out that the US has multiple frontier AI companies, so if one failed, others could take its place. On the surface, that looked like the end of the conversation. It wasn't. 2 months later, in January 2026, Senator Elizabeth Warren sent a formal letter to Sam Altman, and she laid out a timeline that made the walkback look a lot less convincing. She pointed out that back in March 2025, OpenAI had already sent a letter to the White House Office of Science and Technology Policy, asking for tax credits, loans, and other vehicles the U.S. government can direct toward companies building AI infrastructure. Then, in October 2025, before Fryer's comments even happened, OpenAI sent another letter asking for semiconductor tax credits to be extended to the broader AI supply chain. Warren's letter argued that this wasn't one executive misspeaking on a stage. It looked more like a pattern, repeated across multiple months and multiple channels, of the same company quietly asking for the same kind of support, each time in slightly different language. Her letter put it bluntly: American taxpayers deserve to know whether they'll end up on the hook for OpenAI's bills, while executives and shareholders keep the profits. And here's a detail worth sitting with. At the very same time OpenAI was asking Washington for financial cushioning, reports showed and the company was paying its own employees an average of $1.5 million each in stock compensation, more than almost any tech startup in recent memory. So if this story had ended there, it might have just been an embarrassing news cycle. But it didn't end there. It evolved into something far more calculated. By June 2026, Sam Altman had a new idea, and this one didn't get walked back within a day. Following an approach President Trump had voiced support for, Altman floated, giving the American government, and by extension the American public, a roughly 5% equity stake in OpenAI. Based on the company's $852 billion valuation from its March 2026 funding round, that stake would be worth somewhere around $42.6 billion. Altman reportedly suggested other leading AI companies, including Anthropic, Google, and Meta, could be asked to do something similar, though it isn't clear any of them have agreed to. On its face, this looked generous, handing a piece of the company to the public instead of asking for a loan guarantee. But look at what it actually creates. A bailout is emergency money handed over after something has already gone wrong, on the government's terms. This is different. This is entanglement created in advance, while everything still looks fine on the company's terms. If the government owns a meaningful stake in OpenAI, and OpenAI later runs into serious financial trouble, does anyone really believe Washington would just let its own investment go to zero? That's not a bailout request. That's making a future bailout the path of least resistance, without ever having to ask for one directly. It's worth remembering this isn't unprecedented behavior from Washington either. The government took roughly a 10% stake in Intel back in 2025 and has taken similar positions in rare earth mineral and quantum computing companies as part of a broader industrial strategy. So the mechanism itself isn't new. What's new is a private AI company, already burning tens of billions of dollars a year, positioning itself to be pulled into that same category. So where does this actually leave things right now in August 2026? OpenAI's revenue is real and it's growing. Its losses are real and they're growing faster. The spending commitments keep getting revised upward, not downward, 3 times in under a year, from $600 billion to $750 billion, and climbing. The circular deals are real, legal, and defended by serious people on both sides of the debate. And honestly, nobody, not the analysts at UBS, not the critics at Public Citizen, not even OpenAI's own leadership, can tell you with certainty whether this is the sound architecture of a genuine technological revolution or a very expensive way of postponing a reckoning. What we do know is the pattern of behavior. Ask quietly for a backstop. Get caught, deny it. Get pressed by a senator, stay quiet. Then, instead of asking again, offer equity framed as generosity that just happens to make a future rescue almost automatic. If you're looking for the moment this stopped being a story about spending and became a story about risk, quietly getting reassigned from private shareholders to the public, that offer in June 2026 is it. Before you go, if this kind of breakdown is useful to you, hitting subscribe helps a lot. And if you want to see where the AMD and Broadcom side of these circular deals goes next, or how the IPO conversation ties into all of this, that's coming in a follow-up video. Here's the part worth remembering after this video ends. Nobody in this story, not OpenAI, not the analysts, not the senators asking questions, actually knows yet whether this spending turns into the most important technology of the century or the most expensive miscalculation in corporate history. What we do know is that when a company starts asking quietly and repeatedly, who else might be willing to share the risk of its own bet? That's not a technical detail buried in a filing somewhere. That's the real headline. Everything else, the trillion-dollar numbers, the chip deals, the equity offers, is just the paperwork being written around it.